Welcome to episode 71 of Kontrarian Korner. I'm Ben Kellerin. Today we have a very special guest I've been looking forward to chatting with for some time. I think it'll be a very interesting conversation on Bitcoin, the Federal Reserve, the continued trend of debasement, all this other kind of big picture topics that I think are very interesting at the time we're living in. I think we'll have a great conversation. So Roberto, thanks for coming on.
Hey, thanks for having me, man. Excited to be here.
Yeah, so if you're not familiar with Roberto, his former anonymous name is Peruvian Bull. He's the author of The Dollar Endgame, but definitely a Substack worth checking out. And I think we'll get into some of the topics that he's written about before, but I wanted to get into some of the recent events with the Fed, some of the different things, how that kind of ties in with Bitcoin, some of the other crypto stuff that I find interesting, just kind of viewing it from the cheap seats, to be perfectly honest. But what's your kind of view on the recent Fed cut, where that leads, how that kind of factors in with some of the quantitative easing stuff that we were kind of talking about briefly before?
Sure. So, the recent Fed meeting had a cut of just 25 bips, and the dot plot showed basically only moderate cuts in the foreseeable future. And the market was actually, mildly, shocked, right? It looked like SPY was down, Bitcoin was down, trending later in the week. Obviously, gold kept rising, but the overall sentiment was, and I think that this is just also most investors leaning, is that was the wrong decision, that we should have cut by 50 bips. And a lot of people maybe wonder why that would be, right? Like, why would we need a 50 basis point cut right now? And this is, again, a misconception on the market's part that the rate story tells the whole liquidity picture. People think that because the Fed has control of the immediate short-term interbank borrowing interest rate, and because they can lower it and raise it at will, that the liquidity in the system follows lockstep with that figure. But what we found is, like, in the last, especially the last 4 or 5 years since COVID, the liquidity toolbox has expanded much, much farther than just rates. And so that means that the Fed can do a 25 bips cut and then in the background do other actions in what I call like stealth QE mode, and the liquidity increase will be much more noticeable than if they had even done a 50 basis point cut and not done those activities in the background. And the problem that makes it so hard to parse apart, right, is that this is all happening unannounced, in quiet, in stealth mode. No one knows that it's actually happening unless you actually follow monetary plumbing and you have a deep understanding of, repo and general collateral markets. So again, this cut, I think the CME group estimates were basically in consensus that this was going to happen, and only like a 12% chance of a 50 basis points cut. So they followed, the CME futures market expectations, but overall the stock market was still a little mixed on this. And I think it's because of some of this recession data that's been coming in, right? If you look at the PPI, if you look at industrial manufacturing, PPI has been rising a bit too fast for their liking, and unemployment's been staying sticky, right, around 4.3%. And given the debt situation, right, more and more things I think need to be done, which is, again, what they've been doing with this stealth QE. And the stealth QE thing is so big and so amorphous, right? It's hard to parse apart. So I'll just lay it out in like maybe simpler terms. In 2014, the SEC regulated new rules around money market fund, basically exemptions and requirements. And the reason was ostensibly because during the 2008 financial crisis, there was a money market fund called the Reserve Primary Fund, which broke the buck. And broke the buck means they broke the $1 peg, the liquidity peg that they were supposed to maintain with their customers' deposits. So if you tried to pull out one share of the money market fund, it would only return 95 cents when it was supposed to be $1 per dollar, share for your money, right? And that facilitated a bank run essentially on the Reserve Primary Fund, and then that basically cascaded into other bank runs across the financial system and across other money market funds. So the SEC made these regulations forcing money market funds into buying primarily government bonds, especially short-dated treasuries, as their primary collateral, instead of doing what they were doing before, which was more general paper markets, trading like commercial paper, corporate paper, right, unsecured debt, these kinds of things. And that increased, obviously, a large amount of market demand for U.S. Treasuries, especially on the short end. Then they followed the same playbook with Basel III and the later, banking system requirements that made banks load up on what was called HQLA. So this forced another about $2 or $3 trillion of buying pressure to come into the Treasury market, because the banks now were forced to load up on Treasury debt. And for reference, like, let's just put numbers here. The money market funds, as of right now, hold about $7.1 trillion in total funds. Of that, around 85% is in Treasury bills. So that's like $6 trillion or so of demand that's been generated since 2014 for Treasury debt, just by making these regulatory changes. Same thing with the banking sector. There's at least 3 trillion, probably more, because there's obviously repo activities. 3 or 4 trillion of demand that's been generated. And then in 2020, so again, this was happening in the background. In 2020, all of this accelerated because suddenly there's the coronavirus pandemic. There's a huge wave of Treasury issuance coming, and the monetary authorities had to figure out a way to engineer like not only obviously an overt QE with their QE4 easing cycle and the lowering rates to the zero bound, but they had to do even more in the background to keep the wheels on the bus. And so that's when the reverse repo window and the TGA and even the BTFP, right, all came into play.
Say
and
that 10 times fast.
Yeah. It's a lot of acronyms, but their toolbox expanded significantly, right? Significantly.
Yeah, no, it's really interesting because I kind of have like the 30,000 foot view of, okay, you have Janet Yellen issuing more on the short end versus actually like terming out the debt. And that was the whole plan of, oh yeah, we'll just get rates down and then we'll be able to term this out and then run it hot or whatever the plan is, right? And you see kind of what's happened over the last really 7 or 8 months since Trump got into office, and it seems kind of like more of the same. So what's your kind of view on how things have changed since Trump got in versus, hey, maybe it's just kind of all the same? New boss, same as the old boss.
So here's the irony, right? So Janet Yellen back in 2023, early 2023, and then also in Q4 of last year, she was doing Treasury buybacks, right? Which were basically excoriated by former Treasury Secretary Mnuchin, but also, Besant, as being extremely accommodative, as being essentially stealth QE, because the Treasury buybacks by nature are. She was also obviously shifting issuance significantly to the front end. So if you look at, for example, the QRA from the fourth quarter of 2023, they shifted, I think it was like $17 billion a month of issuance from the 30 years to the 5 years and the 7-year notes. So they were moving slowly the issuance to the, further and further to the front end, making sure that more and more of the demand was actually where more and more of the supply issuance was actually where the demand was. Because the problem was that they were running into with high rates and high inflation is that, especially on the long end, the volatility and the convexity nature of those long bonds meant that obviously the bond funds that had bought those 30 years at 0% and now they're trading at 5% have lost their shirt, right? Like the TLT on a 5-year basis is down 50%, 50. So you buy a 30-year bond, you're cut in half in just a few years from the Fed's rate hiking cycle. And so their desire, right, to ameliorate this issue resulted in a couple stealth moves happening in the background. So again, the first was the beginning of Treasury buybacks, which started in 2023 in earnest. They've always done buybacks to a small extent, right? A few $1 billion a year has always been normal because there are certain amounts of what are called off the run issuances, which basically means not recent Treasury bond issuances. So think of like a 30-year bond issued in 2007. So it's not like the most freshly issued bond. And so it's not highly liquid. If the repo market or the Treasury market starts to become illiquid, those securities are most hard to hit generally. And so the Treasury can sometimes do buybacks to increase liquidity on these certain issuances that are getting some strain. That's pretty normal. They started doing, tens of billions a month of buybacks, right, in 2023 and 2024. And then they started shifting the issuance to the front end. And then in April of 2024, I did a research piece on the stealth QE, and I did a deep dive into the Fed's balance sheet. And I found that if you break down the Fed's Treasury holdings by maturity, you see that and you do it over a year-over-year change, you see obviously an explosion in all Treasury securities, upwards as they start QE, and then they start the taper, and the chart goes negative, obviously because they're laying off securities from the balance sheet. But the yellow bar, which is the 10-year, 20-year, and 30-year bonds, stays slightly positive for 2 years. So ever since they've done the taper, ever since they started laying off bonds, they've laid off the bills, they laid off the notes, but everything past 10 years on net, the Fed has not sold. So they're masking their, taper with a secret QE in the background, right? They're saying they're tapering on the surface, which they are, but they're mostly tapering short end because they know they can get rid of the short end debt. They know that there's some demand for that. They know that the long end debt has no demand. So they haven't been tapering basically anything on the long end for the last 3 years. And so that's another move that they made in the background to like keep the engine humming while the markets were, still getting, some downside pressure from the taper. And again, Bessent and former Treasury Secretary Mnuchin were very, very critical of all these moves, saying that it was stealth QE, it was, bad. Like this is not how the Treasury should be operated. And I was a much more pragmatic view, which is again my view towards the Bitcoiners, where I'm like, look, I understand you don't want it to be this way. You don't want stealth QE. You don't even want QE. Okay. But this is what's needed to run the system. Like, you don't think the people in power are going to continue to do what they can to run the system? Of course. So as soon as Bessent got in power, he continued to run the buybacks, and he continued to move the issuance to the front end. So he did no net change to Treasury policy. And in fact, he's been making several moves to increase the amount of, you can call it stealth QE, to basically buoy or bolster support for the Treasury market. So obviously there's the stablecoin play. If you increase stablecoin adoption, at least at even current rates, you'll add about $3 trillion of demand in the next 7 years for the Treasury market, especially on the short end. You can also make obviously further regulatory changes to the banks, forcing them to load up on Treasuries. You can exempt banks from what's called the SLR and the ESLR, which would essentially allow them to buy Treasuries and not hold capital against them. So that would free up even more liquidity. There's all these sorts of things they can do, but Bessent has already been very gung-ho about not only the buybacks, which, for example, I think last week they did another $2 billion of buybacks. Or actually, it was last Thursday. They did $2 billion of buybacks on Thursday. And in the week prior, they'd done a total of $10 billion that week. So again, at as much or even more than what Yellen has been doing.
Yeah, interesting. It sounds like with some of the stuff you're saying with the banks, like they might just get crammed down in the big scheme of things, where they basically someone has to hold the bag. But one of the things that's interesting with all the stuff going on with stable coins, and you see how that's turned into a big demand for bonds, is it's kind of tied crypto. I mean, specifically the biggest ones like Bitcoin and Ethereum and all this, all the largest kind of crypto assets to the Treasury market. So what are some of the things that you see there with where that might lead, as far as, okay, if you have bonds, I mean, my long-term view is that rates are going to have to go higher and significantly higher, or there's going to be like yield curve control, and it all, like, you basically get to pick one or two paths, right? And how does that kind of play out with crypto becoming kind of a new factor, really just in the last year or two?
Sure. So again, I think this is a mixed bag, right? Because on the one hand, you are adding a lot of demand. You're adding a lot of, especially short end demand for crypto. 80% of USD stablecoins are used outside of the US. Emerging market countries, or especially countries dealing with inflation problems, seem to have the highest adoption rate for stablecoins, specifically US dollar-based stablecoins, because those countries are trying to, people in those countries are trying to hedge their local inflation with the dollar, right? And the dollar is, even though there is volatility in the Forex market, obviously, it's a lot less volatile than Bitcoin. It's a lot less volatile than Ethereum. And there's obviously like the legal and settlement issues of, if you wanted to move to the US, like you could take your stablecoins with you, you could redeem them, and you could actually get cash for them. Whereas, with Bitcoin or with other things, there could be more restrictions on that. The problem is that all that demand is basically isolated to the short end, to the front end, right? To the short-term bills. And that means that if the Treasury doesn't want, again, a blowout of rates, you have to match supply with demand. So if, let's say, another 3 trillion of demand is coming online, but it's only for short-term bills because, by regulation, by law, the Circle, Tether, they basically have to be liquid, right? And the highest liquidity instruments are the shortest duration. Most treasuries, I would say, like the best way to think about it is in the fiat monetary system, right? There are multiple forms of money. The most immediate form of money is cash. The second most immediate form of money is short-term debt, expiring in 3, 9, 12 weeks. And then as you move out along the duration curve, the moneyness of the debt starts to decrease and becomes more and more of a security. But in the very short term, like debt markets, right, a repo essentially allows a treasury to be treated as money. You can take a treasury bill that's like a 9-week or 12-week bill. You can go to a repo desk and you'll get 100, 100 to par. So you'll get basically the value of it, or 99.9 to par. Like you'll get basically your money's worth immediately, and you don't have to wait even for maturity. And so that means, again, if the treasury follows the crypto market instead of setting guidelines and forcing the crypto market to follow its issuance schedule, that means that the treasury is going to have to be pushed towards further and further, front end issuance. And again, this is dangerous because this is indicative of what's called an emerging markets crisis. You look at Brazil, you look at Argentina, 80% of their debt is funded on the front end. It's funded on under 2 years. And that's because long-term creditors obviously don't have any trust in the Brazilian or the Argentinian government, because those governments have proven themselves to be fiscally irresponsible. They've proven themselves to inflate away the problem. They've proven themselves to default often. And if the U.S. follows suit, it will guide us down that path, but also make us overall much more sensitive to interest rate policy, right? Imagine if $37 trillion of debt was funded on a 1-year basis. If the Fed does a rate hiking cycle to 5%, within a year, all the debt is at 5%. That's how bad it can get. So
Yeah.
it's a dangerous road to start going down.
I'll have to steal a question that Dave Collum likes to ask when he starts talking about long-term debt, but he always goes like, if you couldn't trade it, had to hold it to maturity, like what interest rate would you demand on US like 30-year on a 30-year bond, right? You have to hold it from now until 2055. Like what rate would you demand?
I mean, I might be bearish. I would say 30% or more.
Yeah. I was like, I mean, at least 10 to 15%, at least, right? You're in the double-digit rates on like, if you can't trade it, you can't get rid of it. I understand why people potentially want to trade in and out, right? And like counter trend rally, all this stuff. But I think you look at all these things kind of from a capital cycle perspective, and at least what I see is that bonds are going to, I mean, in real terms, they're going to get run over the next 5 or 10 years. Stocks, I mean, good luck holding AI and tech companies through a CapEx bubble like that, especially with those valuations. And I'm pretty partial to commodities, and that brings me to precious metals, which has basically been the talk of the town as far as recent weeks. And to be fair, I think it's probably a little bit overcooked in the like near term, but long term, I think you're still looking at a secular bull market for the precious metals, and I think eventually the rest of the commodities as well. So, what's your thoughts on gold and silver? Maybe we can start there.
Absolutely. I've written a lot about gold and silver. Actually, I just released a piece called Silver Slumber, essentially laying the case for why silver has been such a laggard, right? Even though it has started to move, overall, it's far, far behind gold, and it's still at a very stretched gold to silver ratio of like 81. And the gold and silver markets are really interesting because I would say most people think of them as basically the same instrument, and one is just more common, and that's completely incorrect. Gold is primarily a monetary metal that's sometimes used for industrial applications. Silver is primarily an industrial metal that's sometimes used for monetary applications. So think of it like one is 80% monetary metal only and 20% other, and the other is the inverse. And that means that the silver market, for example, is much more sensitive to economic fluctuations. It's much more sensitive to changes in, for example, solar demand or EV demand than gold is. And gold is obviously much more sensitive to monetary fluctuations. So if there's inflation cycles, if there's QE, if there's debasement,
Or
gold moves.
central bank buying.
Yes, exactly. Yeah. Exactly. And I've tracked the gold price now for 5 years. I used to be a massive gold bug. And if you actually look at the actual price action, you'll notice that gold buying generally increases about 12 to 18 months before the next wave of QE. So for whatever reason, and this could probably be because of central banks forecasting the next wave of debasement, it could be just large private wealth funds, understanding the liquidity picture. But gold tends to move much sooner than a large liquidity wave moves, and it moves more aggressively, obviously, in anticipation. So if you look at like August 2020, gold hit an all-time high, $2,070, and then it started retracing. And 18 months later is when the Fed had peaked their easing cycle, and in 2022, in March of 2022, and then they started the taper right in June of that year. And so gold was forecasting that. And so when gold really started its rip in 2024 in January and February, and then it obviously started accelerating in later last year and then into this year, I was pointing out that this is, to me, forecasting that we have another wave of QE coming, and this wave is going to be very or relatively massive, right? It's going to be at least as big as the last one. And we're not sure exactly what will be the catalyst. It could just be the debt markets. But I expect gold to continue rising here because especially the central bank demand has been very, very strong. The last 3 years have been record high years for global central bank demand. Poland, India, China have all been buying in mass. China specifically is an interesting story because their retail demand has exploded. And I have a conspiracy theory inkling that it's because of local economic problems in China in terms of like a deflationary pressures from the collapsing real estate market and investors trying to get into something safer. And China is also very unique in the sense that they're the only major country with a physically settled exchange. So you look at the COMEX, you look at the LBMA, these are mainly cash settled futures exchanges. So if you go buy a gold future on the COMEX, you will 97% of the time just settle for cash because taking actual delivery is very difficult. It's a long, lengthy, difficult process, right? You have to go through and you have to be an authorized participant. You have to have your gold holding audited. You have to have it delivered to a verified custodian like JP Morgan. Generally, the blocks are huge, right? We're talking 400-ounce bars. So like we're talking several $100,000 per single contract. And if you want to make it worth it, you need 10, 20, 30 contracts. So most people just say, I'm going to settle in cash. The Shanghai Gold Exchange is the only physically settled, and it's forced physical settlement. So you cannot take cash. You have to take physical delivery. And starting in 2024, I started tracking their gold prices, and I found that they were rising significantly, about $50 to even $70 above the Western gold prices. And you could see intraday, as the Shanghai gold price would rip, the Western price would start to rise to catch up with it. And so my theory was that this was obviously arbitrage traders taking advantage. They say, okay, we have a physically settled market over here that demands physical. We have a cash settled market over here that you can take physical, but most people don't. And this one's trading at a premium, $70 per ounce. Why don't we go, sell a contract over here, buy a contract over here, take delivery of a couple 1,000 ounces and just ship it over and make free money? And so that's what started happening. And you can see gold imports to China have skyrocketed. Overall gold holdings have increased, in the retail sector have increased by about 25% in just the last 3 years. Bullion demand is growing as well as just jewelry demand there. And so that's, I think, been one of the driving factors driving the price up. That and the central bank buying have been about at least 35-40% of overall demand.
Yeah, it is interesting to see, because I look at it as like the physical metal itself is like the shit hitting the fan insurance for gold and silver. I think it makes sense. Obviously, not specific advice. It makes sense that everyone have at least a little bit of gold and silver on hand, and platinum if you like to speculate a little bit. But do you have any thoughts there on platinum at all? Have you done the digging on that? Because that's one where I look at it and I think it's the simplest, maybe not simple, but the most straightforward like path to 3 to 5x in the next 5 years, and it is more industrial. But it is just something where it is extremely undervalued in my opinion. And when platinum gets moving, it really moves. So have you looked into platinum at all?
I haven't looked into platinum or rhodium for that matter. I know that there are other like tangential monetary metals. And I agree, they can outperform. And that's what if you check out my most recent piece, that's what I said at the very end. I was like, look, for these structural reasons, silver has been in a slumber. Silver's been a laggard. But if and when, or I should say when it does catch up, it will be violent. It will be a quick move, because historically that's how these like tangential monetary metals trade, right? Gold generally can move pretty quickly, but not as quickly, just because it's such a huge market cap. And these smaller monetary metals can rip 10%, 20% in a month, which for gold is basically unheard of. So I agree. I mean, it's definitely a potential, but I don't know enough about the platinum market to give you a good analysis there.
Yeah, that's is one of my favorites. It's an interesting rabbit hole to go down, but would take some time. I don't want to get don't want to get derailed too much, because there's other stuff I want to get into on real estate and kind of the continued debasement, where all this stuff leads and how it kind of feeds into the generational divide stuff. That, I mean, anyone who's spent any time on Twitter or social media really will see what the algorithm will feed based on what you like or what you retweet or whatever it may be. And I think real estate is really one of those things where it's something where if you can start to fix some of these things where like real estate becomes affordable for people that are, I mean, I'm not saying people should be able to buy a mansion when they're 23 right out of college, but should it be something where the only way to afford a house is getting a down payment from the grandparents or the parents? Like, that doesn't seem to make a whole lot of sense, especially when houses are 10 times median income in a lot of places. So what's your kind of thoughts on real estate and how it kind of feeds into some of the generational issues that you see kind of flaring up on Twitter on occasion?
Yeah, sure. So I would say in many ways, right, the real estate market is indicative of the bifurcation of our economy, right? The boomers and the Gen Xers who had time to build wealth before the mass monetization of assets, they've been able to take advantage of this move into real estate, this move of value, this monetization of mortgage-backed securities, and of subsequently of actual housing prices. And they've been able to buy these assets at cheap prices and then profit from the asset rising year over year, right? The average boomer has made more money from their real estate than they have from their career, which is pretty insane to say. But if you look at the housing prices, especially in the West, in the Southwest, on the Eastern Seaboard, you can see how that could be the case. The biggest problem, right, is that in 2008, the Fed began not only supporting overtly the Treasury market with their QE program, which was experimental, whereas the first time that the Western nation had ever done it, but they also were explicitly targeting mortgage-backed securities. And those purchase of those securities, although they weren't in the same way as buying overt houses, it supplies liquidity to the mortgage banking ecosystem because it takes those securities off the balance sheets of the banks, gives them cash, and therefore gives them leeway to lend again and securitize again. And so that meant that the amount of credit and the amount of capital flowing into the real estate market post 2008 started to explode and started to push home prices inexorably upward. In 2020, this accelerated much more, right? Because from 2008 to 2014, the Fed had bought around $2.2 trillion of mortgage-backed securities. And the banks, with the money that they had gained from the Fed's buying, they had turned around and bought another 2.6, $2.7 trillion of mortgage-backed securities, because that money had been created, flowed through to the banks, and now the banks had more cash, so they bought more mortgage-backed securities. So overall housing market support was $5 trillion from 2008 to about 2015, 2016. In 2020, the same process happened again. The Fed starts a massive easing cycle. They buy, $120 billion of securities a month, 90 billion of treasuries, 30 billion of MBS. And that 30 billion of MBS, like clockwork, goes into the FHLA, goes into the Fannie Mae, Freddie Mac, goes into all the securitizers, and just floods them with liquidity and allows them to continue to lend and afford credit to people who not necessarily should be getting that credit, right? And especially at low rates, that made everyone lock in at very low rates and be able to push up those housing prices. Now, the difference between now and 2008 is that most of those mortgages are no longer IRMs, so they're not adjustable rates. So there's no longer the same danger of the entire market imploding when the Fed hikes rates, because we have a lot of people who are locked in at the 2021 and 2022 rates. But it also means that the people who have the homes, right, the people who've already bought them, are kind of stuck there because they can't refinance because the rates are higher now than when they borrowed. They can't really sell, because if they sell and they transition to a new house, guess what? The next house has also, the price is also inflated. So if your home value has gone up by 30% in the last 2 years, 3 years, and then the other home that you're looking at buying is up 30%, well, on net, you haven't actually gained any purchasing power. You haven't actually gained any wealth. You're equal. So you're kind of just stuck with the home that you have. And that's why we've been seeing this, what I would call like a shadow crash in the housing market, this kind of quasi zombification effect, maybe similar to what happened in Japan. The existing home sales, for example, in June hit a 2008 record low. So we collapsed to the same liquidity levels in terms of numbers of sales of homes as we had in 2008. And overall, the prices, not in certain sectors, not in the north and not in the east, but in the southwest and the south, prices started falling as of about 2024. And so we have this picture where, like, Texas, Florida, for example, both those states have seen consistent price decreases for about a year and a half now. And states like New York and California have continued to see increases just because of, obviously the regulatory burdens there in terms of, like, building new housing is even more difficult there. But also obviously, like, the industries there, like finance and tech, which have continued to see increased inflows from, their Federal Reserve quantitative easing quintillion effects. So it's a bifurcated housing market where people are locked in. New people can't really come in. So that's why the liquidity is falling. And in certain areas, prices are falling. And in other areas, prices are still stable or rising. But overall, I think it's a dangerous place to be in, because if you allow prices to be this elevated for this long, especially with young people not being able to earn much, you're essentially pricing entire generations out of the housing market, which will destroy our demographics in the future, right? Home ownership is a key part of family formation. The birth rate, the fertility rate, which has already plummeted to below replacement level in the US and in most developed countries, is going to continue to fall. And if you believe mass immigration is going to fix this, you're wrong, because most of the immigrants that are coming in are generally low skill, low wage, so they can't afford these homes either. So what's basically happening is just the boomers are able to maintain their position, maintain their wealth, and ride this thing out until they die. And then all the young people who want to have families, want to have homes, are being priced out of that opportunity to do so.
Yeah, I think the real estate, the way I kind of look at it is almost like UBI for boomers, the same way Social Security is, and same way S&P always must go up, because people deserve 15% just for existing. And looking at I guess big tech is going to keep working because passive flows and whatnot. But as far as, I guess, one other thing before we move on from real estate, do you have any thoughts on, like, the institutional side of things, owning single family homes, BlackRock, Blackstone, some of these big guys that come in and own, like, large chunks of certain neighborhoods and basically thousands, if not tens of thousands of homes across the US? Do you have any thoughts on how that can be dealt with? And also maybe how immigration could be, if we could get a solution to immigration, how that might be kind of a big solve on the affordability crisis.
Yeah, absolutely. So the fundamental problem, right, is you're allowing institutions with access to huge pools of capital and extremely low funding costs to buy up swaths of real estate and um, not be responsible, obviously, for like the actual flourishing or support of the communities that they're invested in, because all they're looking for is a monetary return, right? They're investors by nature. And so their goal is to squeeze every last cent and to increase profitability. The problem is with real estate, the margins aren't actually that great. And the way you squeeze more profitability out of it is by either lowering your cost, aka lowering maintenance costs, making things more cheaply, right? Like not replacing a sink that's broken, or not replacing a broken furnace. Or you do that by raising rents and raising fees, at like pet fees, parking fees, that kind of thing. And so essentially that just means a lower standard of living and a higher living cost, both combined forever, because their goal is to continually profit drive for their own funds, for their investors who are profit sharing with them in their investments. And there's a report put out which was pretty terrifying, that by 2030, institutions will own 40% of all single family rentals. Blackstone right now owns over 80,000 single family homes, and they've been buying up apartment complexes. They've been buying up condos and townhomes left and right. And overall, it's contributing to pricing out, people. If BlackRock can borrow at 2%, which they probably can if they issue long-term corporate debt, especially at, if
they did it 3 or 4 years ago. Yeah.
Yeah. If they did 3 or 4 years ago, or even now, like, let's say, okay, the Fed funds rate's, 4%, they could issue 4.25% corporate debt, AAA rated. A person is getting funded at 7, right? An individual or a family, even with good credit, is at the high 6s, low 7s, if you look at mortgage rates. So you're paying almost double the interest that a big institution is. How is that a fair game? It's not. So the solution is to ban, and I know this may sound anti-capitalist, but it's ban asset managers from buying single family homes outright. No, you cannot buy, if you're worth over $100 billion as an asset manager, you cannot buy single family homes. It's illegal. You're not allowed to do it. And for their current holdings, you would just make them sell them off piecemeal and go back to investing in equities or bonds or other instruments that are more liquid and less predatory on people, right? Because this is people's homes, this is their livelihood, this is where they go for shelter. This is important. And also, like we said with the fertility picture, we don't want to have the country be basically like halved in population in 50 years just because we have a 0% fertility rate. And if you allow these investors to buy up these homes and drive up prices and then drive up rents, it'll discourage young families from starting to have kids. And that's a negative for everyone.
Yeah, I think it is one thing to have a like fund or large group own like the apartment building that has 300 units, right? That's totally different from like a single family home, just because you're not going to have like a mom and pop landlord where it's like, yeah, we own this like apartment building that's worth like 30 million, right?
Mm-hmm.
It's very different game in terms of size and scale. So I think it would be a good fix. I think there's also things that need to be done on like the immigration side of things too, because like I love talking about all the finance stuff. At the end of the day, if like the demographics keep on this trend that we've kind of seen in my lifetime, it's not really gonna matter much in like 50 years what all this like kind of pontificating about macro looks like, because the country is not going to be what it used to be. So the
no, that's a valid point. Like the United States in the last 5 years, for example, or in 10 years, has let in a massive amount of immigrants, not even to mention illegal immigrants. And these people, are bidding up housing costs. They're taking jobs. Many people are taking government benefits. And overall, that drives up a lot of housing pressure because that just increases demand for the same fixed supply. And the zoning laws have been changed such that building new housing, even in relatively conservative areas, is difficult. There's a lot of building permits, a lot of licensing. You have to own the land, or you have to lease the land with a certain agreement, and you have to have, water rights and have drilling for, make sure you're not drilling into an underground electric or water line. You have to do all this, a land assessment and permitting that makes it unbearably expensive and difficult to build new homes. Right. Another stat is that the permits granted to new home builders is at the lowest in like 6 years. So we're reaching a crisis where you have so many more people coming in and not enough housing being built that it's just driving the housing market into a frenzy, in the sense that like prices have just soared upwards in the last 5 years and made it completely unaffordable. And if you change the immigration laws and made it much more merit-based, much more tight, started deporting people who were here illegally and taking advantage of the system, I would see probably a 10%, 15% decline in home prices pretty rapidly. And, an equivalent fall in rents probably. And that would overall increase housing affordability and ease this pressure. But again, this problem is not going to be solved. This is much more a political issue, right? That's not going to be solved just by what the Fed does or what the Treasury does. It's like there has to be real action taken. And, any country is just the conglomeration of the people, right? The American people are what makes America, America. The British people are what makes Britain, Britain. The Japanese people are what makes Japan, Japan, right? If there's an alien invasion and they abducted all the Japanese people and now Japan was empty and you went there, is it Japan anymore? Or is it just a rock? It's like, no, it's just a rock, right? Because it's the people that make the country. So, the U.S. has been under this almost like mass migration, basically like imposed order for the last 60 years, ever since Hart-Celler, and it's accelerated in the last 20 years. And we need to, halt it if we want to preserve the future of the country.
Yeah, I think people are finding out pretty quickly that it's not just an open air economic zone. And that's, I think, a good thing. I don't know if people are ready for the changes that I would hope for, but I think in the next 5 or 10 years, people will catch up to my politics, but it might be a while. So,
yeah. But and let me say something on that too, right? Like, okay, free market. Like, okay, I agree in a free market. I agree in a fair market. The problem is countries never compete completely fairly. They always have interests aligned to their own people, right? Czechoslovakia, Italy, right, will put up tariffs that defend their domestic car manufacturers. Japan has a 40% tariff on rice. Why? Well, because Japan's a net food importer and a net energy importer. And if a world war breaks out and you're Japan, you kind of want to have a domestic rice industry, even if it means that in the short run, you have higher rice prices permanently. At least now, if a war breaks out, you have that rice production, right? In the worst case scenario, you have food. If you extrapolate that out across countries and right in the competition of, competitive advantage as outlined by Adam Smith, every country is going to be doing things that are in their own favor. And so by nature, the free market is also a competitive market, and it's an unfair competitive market, meaning some countries will push their advantage. They'll put up tariffs, they'll put up blockades, they'll boycott certain goods. They won't allow you to do X, Y, and Z. And the US has been under this paradigm where we allow free trade into the country, but other countries have been able for years, decades, to discriminate against our goods. So, like I said, Japan has had very high tariffs on US rice, on US autos. China has had similar things on U.S. autos, many U.S. industrial manufactured goods. They only really want to have U.S. oil and any high-end chip products that they can use for their computers. But other than that, they're very closed off. Like every country's doing this. We're just the only ones who've been under this impression that we're on this laissez-faire, everyone holds their hands, no one has any interest, capitalism, when that's clearly not the case, not geopolitically, not militarily, and definitely not economically.
Yeah, it is pretty interesting to see some of the people complaining about tariffs and economic efficiency and all this other stuff where it's like, okay, well, if you look at what's been going on for basically forever, I mean, post World War II, really, the U.S. has not been advocating well for its own interests, and kind of the way I look at it. But I do want to get into your view on kind of broader markets and equities, because that's one where I look at um, the stock market and I see signs of a bubble in certain places where lots of money's flowing, and at the same time, it seems like there's a ton of opportunities out there for people that are willing to do like old school bottoms up, like stock picking, basically. But you have all this like passive money flows, all these other distortions that kind of create um, these short term dynamics that don't really make a ton of sense as far as, hey, this is what the business is actually worth. It's more number goes up, so it's going to keep going up, and we're going to keep applying money into it because it keeps going up. But what's your kind of view on the broader stock market and valuations and where all that stuff heads as we kind of continue into this like currency debasement era?
Yeah, so I had a tweet last November that went pretty viral, where I quoted a video, right, and it was the Big Short. It was the, hey, there's a bubble, right, and fund manager Mark Baum, I think, calling his one of his analysts, and it was a chart of Nvidia like soaring upwards and to the right, like literally an exponential.
Yeah, the rhino horn.
Yeah, the rhino horn exponential curve. And I said in that tweet, I said, Nvidia is a bubble, but it's only going to get bigger. And I got excoriated for that because some people thought, oh, you're saying it's a bubble, it's going to crash. And other people thought, what do you mean it's going to get bigger? It can't. That's impossible. That's no.
Yeah, piss off both sides with that tweet.
Yeah. And I'm like, okay, well, I guess you guys didn't get the full picture because I was within just those few words, Nvidia is a bubble, but it's only going to get bigger. I was laying out basically my thesis on equities generally, which is if you look at the, Warren Buffett ratio, stock market to GDP, that's at all-time highs. It's even more extended than 2008 or 2000 in the tech bubble. If you look at, market cap to earnings, also record highs. You look at price to earnings, record highs. You look at Schiller case PE, which is adjusted, record highs. You look at price to book. You look at price to revenue. Everything, record highs. And it continues to climb upwards. The reason why is because of structural reasons with the monetary system and with debasement rather than actual fundamental growth, right? If you look at the stock market in the last 30 years, since 1995, a shocking 90% of all gains have happened since 2008, since the Fed started their hiking cycle. So basically, the stock market's become monetized. And that means that when the Fed does QE, when they create new bank reserves, those bank reserves flow out into the primary dealers, and the primary dealers use it to speculate on securities like bonds and equities, and the prices of those assets rise, right? That's what's called inflation, but it's just inflation in the asset price sense. And so that has driven this massive bubble in everything, right? Now it's not just housing, it's not just tech stocks, it's everything. It's even exploded to crypto, right? We had NFTs selling for $20 million in 2021. The most nonsensical stuff has been inflated to the moon. But this isn't going to stop anytime soon. And the simple reason why is because the Fed, for structural reasons like we laid out earlier with the debt levels, cannot stop easing, whether it's overt easing with a QE cycle and rate cuts or stealth easing with regulatory changes, with reverse repo, with drawing down the TGA, with using the BTFP, all these things. They have to do something to add liquidity into the system. And so, this is like a long-term macro thesis I've had, is that is inevitable, just like the nothing stops this train, meme from Lynn Alden in terms of fiscal debt issuance. The same is also true with liquidity picture. So as liquidity rises, the correlation, for the last 15 years to stock market between the central bank asset holdings and the overall stock market has been about 0.89. So almost 1-to-1, which means as central bank liquidity rises, as cash flows into the system, almost all that cash finds its way into the equity markets, and the equity markets continue to rally. And so I tell people, don't look at fundamentals anymore. Like, yes, okay, fundamentals matter. If you want to do individual pictures, sure. I'm all for investing in individual stocks. I have friends who become millionaires from individual stocks, like, doing an MSTR play that was well laddered with options. Great. Go for it. That still exists. But if you're talking like, I'm going to short the SPY, I'm going to short the NASDAQ because it's going to go down in the next 12 months, I'm very hesitant on that, because obviously we've seen violent price corrections whenever there's been a threat to liquidity. So, like, for example, when Trump initiated the tariff war in April, we saw the S&P enter correction territory very, very quickly, right? Because there's just a lot of leverage built in. But as soon as he moderated, we started climbing back up. And within a couple of weeks, we're back to all-time highs. Why? Because the liquidity keeps pumping in. So barring any exogenous market shock, the liquidity will still keep coming in, and this market will still keep climbing upwards, right? Just like a slow, steady grind. So shorting the broader market almost in any case is the wrong move. If you want to take a downside position, you can buy some puts, but I would keep it short term. I would keep it tactical, because this market structurally is just geared to go upwards. And that's, again, because of dollar milkshake, because of foreign central banks, still buying U.S. Treasuries. It's because of foreign investment funds buying U.S. stocks. We have basically a negative 100% net international investment position, which means foreigners own about $25 trillion of our assets. And every year that number rises because all the dollars that we export to the world get recycled by foreigners and invested back into U.S. markets, either in the form of bonds or equities. Like the Norwegian Sovereign Wealth Fund is one of the largest stockholders of Apple and Amazon, for example. All these things are structural factors that keep driving more and more money into the U.S. stock market. So barring a serious endogenous event, the stock market's going to keep climbing. And even if there is a bad event, right? Let's say there's another banking crisis that erupts. Okay, SPY limit down for a month. You don't think the Fed's going to start easing again? You don't think they're going to start a new liquidity program? You don't think they're going to do something to pump the markets back up, right? A large portion of U.S. Treasury tax income is from capital gains. They don't get capital gains if the stock market isn't going up. If people are getting capital losses, they don't pay taxes. So they want to ensure that the stock market continues to go up, even for just the Treasury income, not even to mention the economic effects of a rising stock market. So I would just say be very, very careful with shorting. Be very, very long-term structurally bullish on the U.S. stock market, because especially in nominal terms, it's going to continue rising for the foreseeable future.
Yeah, I think it is interesting too when you kind of factor in. I've started to do this with other kind of facets of life and expenses, where people say like CPI is like 2%, 3%, whatever. Like I just don't even pay attention to that anymore. But you look at some of these stats on inflation and how it kind of, as you start to see, okay, if inflation is really 5 or 10%, whether it's like the ground beef you pay for at the grocery store, eggs, like you name it, right? The stuff people actually buy is not getting cheaper. And I think a lot of people just see the number, like the nominal gains on something, and not factor in like, hey, you got to think of it more in terms of purchasing power, and not like, okay, you have an investment that went from 10 to 20, but if you inflate half of that away, right, it's tough to it's really tough to make all that pencil, especially when you look at what's going on kind of broadly as far as where some of the stuff is headed. But are there any other topics you think we should get into as far as starting to wrap up here? Like, I know we kind of covered the broad base, everything from crypto to stocks, bonds, even real estate. But is there anything else that like we should wrap up with? I don't know if there's other commodities of interest or other different things that you find interesting, but would love to hear about it.
Sure. Well, one thing we didn't mention is Bitcoin, right? Because I think that this plays an interesting role in the future of our financial system. And I'm not sure, are you invested in Bitcoin, or what? Do you have any views on it in any way?
So here's like my kind of big big picture questions on Bitcoin is one, there's part of me that looks at it as like a digital surveillance gold, and that I'm skeptical about some of the stuff where it comes from. And I'm also kind of long term. I think it kind of sets up for potentially one of the greatest rug pulls in history. So I understand, like I've read the white paper, like done the work on trying to figure it out. But for me, I just haven't been able to get past their, like, there's not a physical real asset there. There's not cash flows. There's not something where I can like wrap my head around it that way. But that actually would be, I think, a great place to wrap up, is kind of your view on Bitcoin. And if you think that I'm off base on whether it's digital surveillance gold, or if kind of what your high level views on Bitcoin are.
Yeah, sure. Well, I understand the skepticism around Bitcoin, right? I was a Bitcoin skeptic for many years. I was originally a gold bug, like I told you. I was very, very invested in gold. I actually was tracking gold miners. I put my life savings into leaps on gold miners in 2020 during COVID, and I thought I was a genius. I thought I was going to make $1 million on a single trade, and the gold miners traded flat for 2 years, which was my expiry, and then I basically lost 95% of the trade. So I had to eat my shirt on that one. But I was increasingly exposed to Bitcoin in 2021 and 2022 as, I started to realize the structural forces of inflation were just going to get worse and worse and worse. And for many reasons, gold, although it's a great store of value asset and it's a great like legacy monetary metal, it likely doesn't represent the future of money, just because gold has a problem with like in terms of usability for small transactions. Gold is actually too valuable, right? If you wanted to go buy a coffee, you would need a couple like scrapings of gold. Or if you wanted to go buy, a candy bar, or if you want to go buy some groceries. And the problem is, just like how, the economic system is based on a Pareto distribution, a monetary system in terms of value of transactions and the number of them is also based on actually like an inverse Pareto distribution, meaning an exponentially more amount of transactions happen between $1 and $10, and then between 10 and 100, and then 100 to 1,000. So exponentially decreasing. So the amount of transactions at $1,000 is something like 100 times less than the amount of transactions at 1 to 10. Right. And you can just think about this on your day-to-day basis. When you go about and you spend money, how many times are you dropping $1,000 or 10 grand? Basically never. How many times are you
like
spending?
How often you buy a car or a house versus how often you buy a dozen eggs.
Exactly. So the problem is gold struggles there, which is why gold has always been intermediated via banks and via fiat money. Bitcoin is the first digital asset to solve that problem, to allow a digital monetary medium that can be divided. By the way, each Bitcoin can be divided into 100 million sats, which are like portions of it. So the actual, usability of it is much more than gold would ever be. And it's also the first to solve what's called the double spend problem, because in cryptography, especially with currencies, there's an issue if I own a wallet, right, and I want to spend my money and I'm a bad actor, I could send you, Ben, some money, and I could also send some money to my friend Robert. And if I don't broadcast both transactions at the same time, but I do them at the same time, then I could trick the system into thinking that I spent the money twice, and it would let me get away with it, if that makes sense, because not everyone would know that I already spent the money with you when I send the money to him. And so that's a fundamental problem of decentralized ledgers. And the Bitcoin cryptographers, the people who wrote the white paper, solved that issue, right? With the proof of work algorithm, with the difficulty adjustment, with the miners and the nodes, the interplay of incentives. And that allowed Bitcoin to be used as actual money. Now, I do agree that the problem, or one of the problems with Bitcoin, is that it's pseudonymous. So if you create a wallet, you use a KYC exchange to unload your coins, the government will know who you are, your address, your government ID. They'll know everything about you, and they'll be able to track how much money you have, right? But if you use a non KYC service, you set up a a Bitcoin miner, for example, or you buy through a non-regulated exchange, you can get coins on a wallet that has no association with your real name. So it'll just be wallet, BC1QF25887Z. And then all the government will be able to see is this wallet sent money to that wallet. And they don't know who's on either side of that. Even though it could be you just transferring money in between your own wallets. It could be you sending money to your friend. It could be you paying off a bill. It could be you getting paid. It doesn't necessarily mean that it will be tied to you. Now, I think the Bitcoin ecosystem has to improve in the sense of their privacy measures. A lot of non-Bitcoiners don't know this, but there are things called coin joins, which are essentially like a mixer. So let's say you, Ben, were like worried that the government was tracking your Bitcoin, and you bought all your Bitcoin on Coinbase or another major exchange. You could go to a mixer or a coin join. You could throw in your coins, and it basically tumbles them between 10, 20,000 addresses, like washing it, and then it spits them out into a new address. And then it would send you privately the keys and the information to the new address. And so the government would never know how much Bitcoin you actually had, because essentially all your money would go into a tumbler and come out the other side, and they don't know which wallet is yours. And of course, the tumblers take a fee. I think it's like 2 or 3% for doing so. But there are ways to re-anonymize your Bitcoin even after you've suffered from being doxxed by using a KYC exchange. And as for like the whole intelligence angle, I don't know. I think that like if I was the Central Intelligence Agency and I wanted to impose digital surveillance money, I would choose something much more easily trackable and like identifiable than Bitcoin, because like I said, Bitcoin's a pseudonymous instrument. It's not anonymous, but it's pseudonymous because your pseudonym is just a random number of strings and characters, aka your address. A central bank digital currency, like what's being promoted in the ECB, was already being rolled out in South Korea, for example. They had a project called Hang, which rolled out a retail CBDC to 100,000 people this summer. Is a much more effective way of doing so, because by virtue of using a CBDC, you have everyone in the TradFi banking system set up an account with your local central bank, and then all the transactions are verified, settled, and crossed through the central bank. So they will not only will the bank see, obviously, Ben, your transaction, it'll be the central bank can track your entire net worth, all the transactions, all the people you're interacting with at all times, and they can shut it off. It's completely programmable. They can change the interest rates you pay. They can put up punitive penalties. So like, let's say you go buy cigarettes and it says, oh, we identified a negative transaction there. We're going to dock you 5 USDC for doing that. Or, oh, we saw you were at a protest we don't like. We're going to dock you 500 USDC. Or, hey, we're experiencing deflation right now, and we're going to impose a negative interest rate policy, just like the Bank of Japan did. So now all of your deposits earn negative 3% per year. So you have to spend your money or you start losing them, and it'll just be deducted monthly from your account. Those kind of things are all possible with a CBDC. They're not possible with Bitcoin. So if you were on their side creating an evil plan to overtake the world, it's much more effective to push the CBDC route than the Bitcoin route, because just by the nature of Bitcoin, it's extremely uncensorable. It's extremely hard to change. It's extremely difficult to modify. And like I said, it's almost like boomer technology in the sense that it's very slow to adapt. It's very slow. You can't add new features easily. Actually, basically ever. Like the only few new features they've been able to add are things like SegWit, and small adjustments to like fee sizes, or there's right now like a civil war going on in core versus knots versus like the type of basically like information you can append onto a transaction. But all that is to say is like it's a very, very old clunky cryptocurrency, and if you were trying to instate a global surveillance apparatus, it is not what you would use. You would want to have something with much more visibility, much more tie-in to actually who you are, and much more control. And so that's why I don't think it's, the honeypot that some people think it is, although I do understand the reservations.
Yeah, no, it's interesting because I've kind of gone back and forth on buying a little bit and trying to like figure it out more as you have skin in the game, right? But
Mm-hmm.
the thing that always I always get stuck on is like I kind of view it as an extension of, like you're saying, like a bubble in everything. And if like I just don't know how to value it. That's like the
Mm,
biggest thing of like I go back to what is something actually worth when I look at investments, and that's where it gets really hard for something like Bitcoin, where it's like, I mean, compared to what might or might not come out in 5 years, or what other new cryptos are coming, or whatever happens, like I just don't know how to say, hey, this is worth 100,000 or 150, or it's
mm,
going to 1 million. Like I just don't know, you know.
mm.
So
It is difficult because it's a new instrument. It's trying to be a new monetary medium, and the way to value new monetary medium is very opaque, right? It's not a price to earnings. There's not a cash flow. There's not a dividend you can forecast out. It's like if you were sitting in Britain in 1947 and you're like, how do you value the dollar or a new world reserve currency under Bretton Woods? What's the dollar worth? You would have no idea, right? It's difficult. And so even though obviously the dollar has done extensively well, especially if you look up like comparatively, the dollar has lost less value than most of the fiat currencies because all of the fiat currency have devalued, and they've devalued even more in relation to the dollar. The yen, the pound, the euro. But the dollar has retained its purchasing power better, even though it's fallen 99% in the last 150 years. It's just overall comparatively better. And so that's what I would end with. And I can send you, if you want, or if you're interested, I can send you some research pieces that are written by very intelligent people that describe like the difference between Bitcoin and crypto, why Bitcoin is, unlike other digital assets, why it's so hard to change, why it's so immutable, why it's uncensorable, why it's, hated by a lot of central bankers and governments, right? I can send you that stuff if you're interested. And
yeah, I'll
yeah,
definitely take a look. So as we start to wrap up here, I do have to ask my traditional closing question, which is, what book should I add to my reading list? Can be history, finance, investments, anything you think I'd find interesting.
Okay. And completely anything.
Anything.
Okay. Can I give you a couple, or does
Sure.
it have to be one? Okay. The first I'd recommend is actually a Roman history book called "The Storm Before the Storm" by Mike Duncan. It's a really good deep dive into basically the days before Caesar and the last, I guess you could call it like the last gasps of the Roman Republic, and the following of generals like Sulla, who basically came in and responded to political crises by creating more political crises. And it's very, very analogous to our current political paradigm. So I would highly recommend that book. A very good read. I would also, if you're obviously a macro guy, or interested in international, capital and the dollar's role as a reserve currency, which is the main thesis of my writing, I would say the Mr. X interviews, volume 1 and 2 by Luke Roman, are excellent. Those have been like some of my favorite books to reference back to and to learn from in the last few years. And then finally, I mean, obviously you can go back and read like the classics of like Adam Smith, Mises, Rothbard. But if you want another, great macro read, I would also recommend some books on like the petrodollar system. I believe, what was it? I can't remember the name of it. I can look it up really quick, but there was a really good petrodollar book I read years ago. And it completely changed my mind on how the U.S. approaches foreign policy, how we approach the Middle East. And that book kind of opened my eyes also to the Eurodollar system, which is also the, if you haven't had Jeff Snyder on, I would highly recommend you have him on, because that's the hidden like psych, or the hidden banking system that basically enforces dollar hegemony by creating dollar demand abroad. Yeah, it's called The Hidden Hand of American Hegemony by David Spiro. That's what it is.
Interesting. I'll have to check all three of those out. I had Luke Roman on the podcast recently. That was one of the better conversations I've had. Definitely interesting stuff. So I'll have to check out the books he's written. But if my listeners are looking to find your work or your social media, where can they look for you?
Sure. So I'm on Twitter You can just search Roberto Rios or at Peruvian_Bull. I'm also on Substack. If you look up Dollar Endgame on Substack, that's my Substack. I've a couple thousand readers. And then I have a YouTube channel, which is just Peruvian Bull. And so if you just search Peruvian Bull on YouTube, you should be able to find me. And we're focusing right now on switching to much more long form mini doc content, much more deep dives. We were much more focused on like market commentary just a few months ago, but we're switching back to the deep dives because that's what our viewers wanted. So yeah, expect more like mini doc style content there soon.
Yeah, it's definitely worth a follow, and definitely go check out his stuff on Substack and on the YouTube. So I really appreciate taking the time coming on. Definitely had a fascinating conversation. I'm sure we'll have to have you back again as all this stuff starts to play out. I'm sure gold will be 4,000 an ounce by then, and silver will be at all-time highs, and we'll see where all this other stuff goes. But I think it'll be interesting to see how this whole kind of debasement trend plays out. But I think with that, we'll be wrapping up. Thanks for stopping by, and we'll see you next time.